Hi, everybody. This is MC, the Accountant Shares, and this is the fourth episode or session of installment sales or installment sales method that we have discussed so far. So as you can see on the screen, you can see the word reposition because our topic for today is all about such. Now, if we say reposition, basically what is being sold by us is obtained by us as sellers again because our customers did not pay the subsequent installments or series of payments. Now, we've done already a lot of short notices or perhaps many notices depending on the contract or policy of the company as to how many installments that we are going to consider such to be ready for reposition. So as a rule, the seller reserves the right to repossess the property. Let's have another picture. So here, this is a sample picture wherein the contract of sale is all about house and lot. For sure, you cannot have house without the lot. So if somebody is selling house, it should be a lot also or with a lot. Now, the house that was sold and is owned by the seller still, but is being allowed to be used by the customers or buyers. But you can see here the strings attached to the house because the buyers still are using the property, for example, still, but then the seller now is exercising the right to get back such property or to seize such property. And you call this again the right of reposition or the right to repossess the property. So after that, if, for example, the buyers or customers would not really pay, so the seller will exercise the right and the property now is really repossessed. Okay, so question is, why is there a policy for reposition? Why is that really allowed? Now, take note that there would be risks involved when the seller sells the property in installment, most especially that this is going to be long-term or for so many years. What if the buyer cannot pay later on? So if the seller does not reserve this right, the seller cannot at least recover itself based on what has been remaining out of the repossessed property or the used property of the buyer. So in a way, this is a protection on the part of the seller. Aside from having down payment, interest, there is also the right to repossess. Okay, now for certain terminologies, for example, the right to use, that is called usufruct in our legal terms, in the legal aspects. And then let's have it here. Let's try if we can type. So it's called usufruct. That's a spelling. Okay, so this is usufruct as being said under the law. That is the right to use the property. Now going back, hopefully that is clear. So I'm not really used to using the whiteboard. Anyhow, so let's proceed and let's have the theoretical background. So protection for the collectibility of the consideration receivable. That's why the seller reserves the right. So if the problem is silent or even in real situations, that right really is reserved. So how do we account for the repossessed property? If we are using perpetual inventory system, we are really going to debit it to an inventory account, and it is to be recorded or debited to fair value. What is the value of such as of the time of repossession. However, what if the fair value or appraised value could not be obtained? So we are going to estimate the fair value. And how do we compute that? Is the estimated selling price less the reconditioning costs. Of course, for the asset or inventory to be saleable again, we need to spend costs so that it would return to its normal operating condition, if not really the original one. So those costs are to be spent and there would be profit margin. Of course, after spending the cost plus the value when it was obtained, so there would be a margin, a certain percentage. That could be different from the gross profit rate when the time that it was originally sold. That is really possible in answering problems at the date of reposition. It's very important that the emphasis here is when we determine the fair value or the estimated one, it's really at the date of reposition. We also need to know the balance of the receivables and the deferred gross profit. However, we all know that the deferred gross profit is directly proportional to installment accounts or notes receivable with respect to the gross profit rate. And the difference between 1 and 2 is called the gain or loss on reposition. Okay, now for accounting purposes, gain or loss on reposition would be computed, especially if they're asked in problems. However, in terms of financial reporting purposes, in terms of recording the accounts, the gain on reposition is not recorded under conservatism or prudence concept in financial accounting and reporting, because recognizing that gain may result to an income that will never be realized or that might not be realized. On the other hand, if we say loss under conservatism or prudence, which dictates or states that we anticipate no gains but expect or anticipate for all losses. So that's why losses should be recognized in the books of or in the books of accounts of the business. So here are our illustrations or sample problems. So this is all about reposition with appraised value. The appraised value is given as 6,000. Requirement, when we answer problems, look at the requirement or we look at the requirement. Gain or loss on reposition. So what's the formula? Again, that's going to be, it's not shown, but based on the discussions, appraised value, that's priority 1, or the estimated selling price, that's going to be less reconditioning costs and normal profit margin at the date of reposition, which would equal to estimated market value or fair value. So meaning appraised value 1, second is estimated fair value, less the cost of installment receivables, which is the difference between installment receivable and the deferred gross profit account. So in this case, we have 6,000 appraised value. That's the debit to inventory. This is perpetual inventory system. And then how do I know? Because we debit inventory. So as a rule, in perpetual inventory system, when we debit an asset, it's going to be at inventory and all changes should be at inventory. In fact, we can even attach the word reposition. So merchandise inventory to be more complete. Merchandise inventory dash repositions to indicate this as reposition, because later on in the next session, there would be trade-ins that will also be discussed. Now, how do we know if this is periodic inventory system? The account to be used is repossessed merchandise. Okay, so 6,000 appraised value less the cost of installment accounts receivable or unrecovered cost. That is 10,000 times the cost ratio of 70%, so 7,000. That's why 6,000 minus 7,000, which is the net of these two, would be 1,000, a loss on reposition. So this is the journal entry way of showing it, but I've discussed to you the formulaic way. So 6,000 minus 7,000 equals 1,000 negative, which is an indication of a loss on reposition. Next, illustration 2, what about a reposition with estimated resale price? So we have to compute the following items. First one is gain or loss on reposition. Meaning, if we say estimated resale price, by the way, the book is just showing us the situation, but in exams, without indication. So it will be really us who will analyze. So you have here, repossess a property which was sold for 20,000 and then 5,000 was collected. This simply means that the 5,000 when deducted from 20,000 is the balance of installment account receivable, that's 15,000. The resale price is 17,000, which is not yet the fair value, less reconditioning cost of 3,000. So that's going to be the estimated fair value at 14,000. But then there's also a normal profit margin. So how is this obtained? The 30%. Okay, it's here because it is given in the problem. Otherwise, if not, for example, we cannot really determine, so we are just going to deduct the reconditioning costs from the estimated resale price. Again, if without given profit margin. Take note, this is at the year of reposition. So the fair value of repossessed property estimated, it's 8,900. And then I told you or discussed that 15,000 was the balance of installment accounts receivable. So what we can do is that we can multiply that 15,000 with the cost ratio. GPR in 20x1 is 20%. And so 100% minus 20% is 80%. So that's going to be 12,000. 8,900 minus 12,000 is the loss on reposition of 3,100. So notice that in terms of computing the gain or loss on reposition, we really used the gross profit rate at the original date. But in terms of computing the current estimated fair value, it's going to be at the year of the reposition. Okay, so it's here, that summary. Normal profit margin is computed based on the year of reposition, but the loss, gain or loss, when computed, I mean the gain or loss on reposition, that will use the GPR in the year of the original sale. Okay, what about requirements B and C? Total realized gross profit in 20x2. So you have here the sales, 320,000, and the installment receivable of 144,000. So the difference is the collections in 20x2. For 20x1, that's going to be the installment receivable at the beginning of 20x2, which is 90,000. So this is the end of 20x1. The end of 20x1 is the beginning of 20x2. So the difference is 60,000 less the uncollected receivable, which is 15,000, and that's going to be 45,000. And we multiply respectively with the appropriate gross profit rates of 20% and 30%. Now we can also make use alternatively the T accounts format. We can just notice here that the collections and write-off would decrease the receivables because when we perform such transactions, we are going to credit the receivables. Let's go back to how gain or loss is being computed, and the entry when there is reposition, we credit installment account receivable. That's the reason that we will decrease installment account receivable or notes receivable when we have such repositions and even collections, because the entry is cash in bank, debit, and credit installment accounts receivable and notes receivable. And here are the computations. So we can now then say that this might be profit, but still we're lacking with expenses. That's why I'm not really fully convinced about the usage of the word profit here. Probably the net impact to income for the said reposition. So realized gross profit from installment sales and the loss on reposition. So the profit or the net effect to profit is 58,700. Okay, so after that, you have here illustration 3, that's the fair value after reconditioning costs. Okay, hopefully you're still following, guys. Now, we have to be clear about the words which are used here. When we use the word after in installment sales, what is meant here is that the fair value is with reconditioning costs. So meaning this is the value after we recondition the said repossessed property or used property. Because it's possible that our analysis or thinking would be that the items are net or the inventories repossessed are net already of reconditioning, especially in mathematics. Because if there is the word after, we think of minus. But then this is really English, like fair value after we recondition the cost. And going back to the formula, let me just highlight that for the last time, it's less reconditioning costs, because I will not go back to that part as we go along. Okay, so gain or loss in reposition. You have here the fair value, 6,000 minus 500, that's 5,500. If we deduct 500 from 6,000, that is the fair value before reconditioning cost, meaning we need to know how much really was the value before we reconditioned such property. Remember, gain or loss in reposition is completed at the date of reposition. This 6,000 was the value after the date of reposition. So we go back in time. This is 5,500. Okay, so again, this is now the value or fair value before reconditioning cost, or the fair value at the date of reposition. So this is the amount that we are going to record. Inventory, again, could be merchandise inventory dash repositions. So hopefully you are taking that down, because I may not be able to write here properly. So merchandise inventory dash repositions if under perpetual inventory system, but if periodic inventory system, so that's going to be merchandise inventory dash, for example, trade-ins could be dash trade-ins, but then this is reposition. If periodic inventory system, rather, it's going to be repossessed merchandise, okay? And for trade-ins, it's going to be traded in merchandise. So we are going to go back to that as we have trade-ins in the next session. I repeat, if periodic inventory system, it's going to be repossessed merchandise. If perpetual inventory system, which is what we are going to use if the problem is silent, it's going to be merchandise inventory dash repositions. And then how do we record the capitalizable? When we say capitalizable in financial accounting, we mean that that amount is to be added, is going to add more benefits, additional benefits to the inventory or asset, therefore should be capitalized. So that's why overall it's going to be 6,000, the value of the inventory. Okay, but at the date of reposition, not yet the 500, not yet included. So the requirement be the new cost basis should be 6,000, and this would be the amount that will be shown on the financial statements after we post the respective entries. When we say post, we mean we place those amounts or transfer those amounts from the journal to the ledger. So just a review of accounting 1. Next, illustration 4. What about a profit on resale of repossessed inventory? Which is normal, because when we sell again our respective repossessed inventory, will we allow or should we allow to lose in the process? I don't think so. This is business. Accounting is the language of business, so we should be earning in the process. Anyhow, let's analyze. These are the situations for the repossessed inventory that was prior to reposition, and this one is at the date of reposition. Okay, So compute the following items. Gain or loss on reposition, that's going to be, it has an appraised value of 10,000. Then at reposition date, it spent 2,000 in reconditioning. Take note that 10,000 is at the date of reposition. Therefore, that's going to be the amount that we are going to put such in our recording or journalizing of the reposition. And then the installment accounts receivable balance would be 40,000 originally. That's the selling price, and the AR, they're equal, minus the 28,000 payments or collections on our end as sellers. That's going to be 12,000. What about the gross profit rate? Simple. There is selling price minus cost. 40,000 minus 30,000 is 10,000. Divided by 40,000, that's going to be 25%. And as what I've said, to have a shortcut for computation purposes, we can just simply multiply the ending balance of installment accounts receivable 12,000 times the cost ratio of 75%. Or we can also have something like this: installment accounts receivable 12,000 minus the 3,000, that's going to be 9,000 pesos. The same, but then the latter version, which is the longer, is good for the journal entry purposes. So mind us that the shortcut that I've mentioned prior, which is the installment account receivable times the cost ratio, which is the difference between 100% minus the gross profit rate, is just for the sake of simplicity of computation. But the journal entry remains the same. I hope that is clear. Okay, what else? Requirement B, realized gross profit from resale of repossessed inventory. So you have here the appraised value at 10,000 and the 2,000 reconditioning cost. So that's going to be the new cost. What is asked here is the realized gross profit. Okay, so you have here sales price or selling price, the resale price of 15,000 minus 12,000 new cost equals 3,000. Divide 3,000 by 15,000, that's 20%. That's the new gross profit rate. 25,000 was prior, 25% was prior to this 20%. And then 6,000 multiplied, by the way, 6,000 was or were the total payments coming from our customer. So it is our collections. That is on our end. 6,000 times 20%, meaning the realized gross profit from resale is 20%. What's the lesson here? The cost of reconditioning, another word is refurbishing, is going to be added to the cost of the repossessed inventory, which is actually the appraised value, for the purposes of computing the revised or the new gross profit rate, because the 2,000 reconditioning cost is a capitalizable cost that should be added to the cost of the repossessed inventory. All right, I hope that is clear. We can realize this by this previous problem in terms of the two entries, debit to both inventories. And here it's just automatic, not with journal entries. All right, next one or next item is reposition at present value. So in this case, there is installment notes receivable, and let us analyze. The selling price is here. This is the cost. Question, by the way, is RGP, realized gross profit from the sale, and gain or loss on reposition. If we see this particular part, that there is monthly installments, and then there is talking about imputed or imputed rate of interest, we should be thinking already, our mind is ready to think about amortization table, possibly, but let's check if this is interest bearing or non-interest bearing. For non-interest bearing, there is really a need for amortization table to make our lives easier. We can make use of that still to interest bearing, but it's just that we are going to analyze deeply. Okay, so the imputed rate of interest per month is 1/2 of 1%. And then let's look for clues if this is interest bearing or non-interest bearing. Okay, this is cash price equivalent. Oh, so in that case, that's going to be non-interest bearing. So whatever is the collections, that's going to be inclusive of interest. So that's why we are going to deduct whatever is the interest income from collections to get amortization or reduction to principal. Well, anyway, in terms of interest bearing, there should be the words like the collections or installments should be this amount, 10,000, plus the interest. But because of the word imputed and no mention of installment plus interest, so this is going to be non-interest bearing. So again, ready with the amortization table. So how do we compute realized gross profit? That's going to be the reduction to principal applicable for this year. This is 20x1, and then there are 24 equal monthly installments. This is January 1. Okay, so let's check. Well, this is reposition, and then there were only 3 timely payments made. Okay, so that's why we are going to compute based only on the 3 payments, not for 12 months or good for the year 20x1. Because if the contract continued and it will be asked how much is the realized gross profit for 20x1, it's going to be all 12 months. All right, so cash price equivalent as given minus cost of sale, this is the gross profit. And this is going to be the gross profit rate. And we make now the amortization table. This is the present value. And then the collections, this is the down payment. Let's check. The first payment is to be made beginning on January 1, 20x1, which is also the transaction date. Therefore, that's going to be an annuity in advance. Fortunately, we are already given the cash price equivalent. As being said, when we talk about the non-interest bearing, we think of the 2 priorities. First is fair value, which is normally the cash price equivalent. That's the first one. If you can notice, it's very similar to reposition, wherein we begin with fair value, and second one is estimated fair value. The estimated fair value here is the present value of the notes receivable. So let's check that. This is the present value. And then to continue, we have to make the table and simplify the items here. So amortization is collections minus interest income. And whatever is the present value is the balance prior. Present value is the balance, also known as book value or carrying amount. And then minus the reduction to principal. So 226,757 minus 10,000, this is the amount. This amount minus this amount equals this amount, and so on and so forth. All right. So for the year 2001 or 20x1, which is only good for 3 months or 3 timely payments, when we get the total of these 3 items and we multiply with gross profit rate, that's going to be the realized gross profit. All right. So that's how we compute for the first one. What's the lesson here? So again, we have to identify first if the note is interest bearing or non-interest bearing. Interest bearing, the clues would be installment plus the interest if it's not stated in the problem that the note is really interest bearing. If without those words, then we are going to really assume that it is going to be non-interest bearing, in which we think also of the priorities. If without cash price equivalent, which is the fair value, then we are going to estimate the fair value, and that is the present value. I hope that is clear. Okay, that's for the requirement B. Now, you can notice here that the inventory at fair value is this amount. So how is that obtained? It's given in the problem. Good thing, otherwise we have to estimate. Then installment accounts receivable, it's here in the problem. Then the deferred gross profit is based on the original gross profit rate or the ratio. And then it's a gain on reposition. So that's going to be 9,922. However, there could be some debates about here. I don't know about Milan, but then which I also favored that in terms of gain on reposition, that's not going to be recognized because it might result to a gain that will never be realized. So let's find out like who really is the correct entity or person here. But then what's the requirement in B? Compute. So compute, this is the amount. But then if this is going to really be the journal entry, this is not going to be recorded. This is going to be an X. And so what will be the entry? So it's just going to be inventory at fair value, and then the installment accounts receivable. So you just have to close that. And then the difference would be at the inventory at fair value. So meaning the inventory at fair value will absorb just the difference. So meaning the inventory at fair value will be at cost. The cost, the unrecovered cost. All right. For now, for the meantime, unrecovered cost, and in the next entry, there would be an adjustment to the inventory at fair value. So inventory at fair value and could be the adjustment to accumulated profits and losses. But anyway, that will not be asked normally in examinations. What would be asked would be how much is the gain in reposition, which is to be computed. But then in terms of is it really going to be part of journal entry? So there are like conflicts. But what I've known so far, majority of the authors will be saying that this is not to be recorded. So that's why the inventory at fair value would be the difference of the two. So the cost ratio or the cost that is unrecovered. Okay, I hope that is clear. Now, illustration 6, reposition error. That is possible, or it is possible that there would be errors on the journal entry. So we all know that in terms of such, if errors are committed, then we make adjusting entries. So in adjustments, we're just going to think of 3 columns: the entry made, the correct entry, and the adjusting entry. The basic concept is that whatever account that was wrong or whatever accounts that were wrong would be closed, and whatever accounts that were not recognized should be recognized. That's the summary of adjusting on erroneous journal entries. Anyway, so compute for the correct amount of gain or loss in reposition. So we have here the inventory new merchandise at 2.5. Take note that what was the practice or what was made by the accountant was that when there was reposition, the debit is lost on reposition and the credit is AR for the unpaid balance. So probably there was really a clear error that was committed. Supposedly, it should have been a debit to the inventory at the fair value or appraised value, if not estimated one. It's actually given here that at the date of reposition, 1.5 was appraised value, but given here it's 2.5. So this is the inventory ending, so ending balance. That's why this is not going to be really our repossessed merchandise. This is 1.5. And then the debit also would be at the loss on reposition if there is one, and also debit to deferred gross profit. The gross profit portion that is still deferred for the installment accounts receivable. But it is going to be closed because the account is already defaulted. The customer would not pay anymore. The buyer do not pay, so we are going to close it. The repossessed inventory was neither recorded nor included in the year-end physical account. Okay, so it's not part of 2.5. So compute the gain or loss on reposition. So first, we have to know how much really is the gross profit. So cost of goods sold is at 37,500. And then I think there were some concerns on alignment. Okay, so compute cost of goods sold, that is inventory beginning at 37,500. So basically, if we're done already with merchandising concern, the compute cost of goods sold, that is inventory beginning, we add net purchases, and net purchases is already the balance of having the inventory beginning plus the gross purchases less the discounts, returns, and allowances are to be deducted also. We get the total goods available for sale, and when we deduct the inventory ending balance, that's going to be the cost of goods sold. So 37,500, and then we, for example, computed the cost of goods sold. So here, 0 beginning, 25,000 purchases. Why is 0 for the beginning? This is the first year, all right? So 0, purchases 25,000, repossessed merchandise 1,500 for a total of 26,500. Less the repossessed merchandise, which is 2,500, and we add 1,500 that is not yet recorded or included in the count. Okay, so 4,000, so that you have 22,500. 37,500, sorry for the misalignment. This is actually the installment sales. Let's check, okay, as given. That's why we had a confusion. So 15,000 is gross profit. And we can now compute the gross profit rate, which is 15,000 divided by 37,500 at 40%. So when we record, installment accounts receivable is at 4.5. Let's check here. Why is it we use like the amount for loss on reposition? Since the entry made by the accountant is when there is reposition, the debit is loss on reposition and credit installment AR. So meaning the recorded loss is equal to the installment AR or accounts receivable. So you have 4.5. And 4.5 times 40%, which is the gross profit rate, that's 1,800. The difference is unrecovered cost. That's going to be how much? 2,700. Please deduct. And then 1,500 fair value less unrecovered cost of 2,700 equals loss on reposition of 1,200. Okay, so what's the lesson here? Errors might be computed or made by the accountant or whoever is in charge with recording. And normally, the recording of reposition might be done later on or at a later date. So that's why there's a need for us to go back at the date of reposition. There might be possibilities of deducting the reconditioning costs from fair value after reconditioning cost. Because again, we have to go back to that date. And I've told you a shortcut in which we can deduct the unrecovered cost, that is cost ratio multiplied by installment accounts receivable, and we deduct that from the appraised value, if not given estimated market value or fair value, and that's going to be the gain or loss on reposition. If loss on reposition, then it's going to be recorded in the books. If gain, not. If loss, our clue is that the result when we deduct unrecovered cost from the fair value or estimated fair value of repossessed property is that it's negative. If positive, it's going to be gain on reposition. All right. So hopefully you learned a lot from this session. Next is trade-ins. It's here. That's going to be in our part 5. It's now part 5. This is quite a long or lengthy chapter. Anyhow, hopefully you learned something again. Don't forget to subscribe to my channel. Don't also forget to share this particular video to your friends who really wanted to learn accounting the easiest way possible. And then I'll see you next time for the next session and other videos for the channel. You watch out for more content and stuff. Bye for now. Bye.